Well, good evening, everyone. Welcome to our Association of Former Students Homebuyer Workshop, your master class in home buying. Great to be with everyone this evening. I know we're in different time zones tonight, so we're primarily starting in the central time zone. I appreciate you guys dedicating some of your evening to just learn a little bit more about home ownership. This is a class that we provide to the association 4 times a year. It is a very interactive virtual class to help really answer all the questions you might have on first-time home buying. So we hope that you'll have some tools and some resources to take away from tonight's class. We want to be really interactive with you during this session too. So please feel free to use the chat or the Q&A feature within Zoom. I'll be answering your questions live on air. We'll also carve out some time later on in tonight's discussion if you have any follow-up questions that I can help you with. And then what we'll do is we'll share back all of these slides to you via email tomorrow. And we are also recording tonight's class. So we'll have that video up on our YouTube channel. So if you have to step away from your computer or whatnot, you will have a recorded version of this. We are really excited about what we're doing within the community of A&M, and we've got a chance to help some of your fellow alum. In fact, just about an hour ago, I was updating a pre-approval for one of your fellow alum that's purchasing in the Corpus Christi market. And so these are the engagement we're having with some of your fellow alum as they kind of graduate, so to speak, from these classes to help design some different home buying options, get them pre-approved so they can start actively shopping. So later on in tonight's class, I'll also share with you like the buying process. What does it look like? Where do you go from here essentially after we leave tonight's class? Well, again, my name is Jason Maida, so I'm going to be your host this evening and presenter. A little bit about our organization. So I work with a company called American Pacific Mortgage, or APM is how we're known in most markets. And our team in particular partners with local university alumni associations like the former students to be able to help provide value-added content when it comes to home buying. So we put on these classes to help kind of really get connected with you in your local community. Part of that connection includes, talking about relevant information that can help you on the path towards home ownership. And so what we'll do is we'll talk tonight about the housing market, what's happening with interest rates, because that's probably top of mind of everyone in the room, and including our clients that I work with all across the country. We'll talk a little bit about credit. How are some, what are some ways to build my credit up? Maybe some different resources I can pull from, loan programs that I can tap into, including first-time buyer programs. We'll talk a little bit about savings for home ownership. That could be one of the bigger challenges for most of our buyers that I help out. And then, as I mentioned earlier, we'll talk about the buying process. So as we leave tonight's class, I think about home ownership, and I want that to be a financial goal for me. Where do I go from here? And then I'll kind of pass along some information to you guys about how you can get scheduled for your free consultation. All right, so that's kind of our talking points for tonight. Look forward to getting some of your questions as we roll through our presentation. But let's kind of launch into home ownership and think about the benefits of home ownership, because when we figure out our budget for home ownership, some of the things I'm going to point out to you may not be factored into your own personal calculations. When you look at home ownership, you have the opportunity to create more of a fixed payment on a monthly basis, so you don't have to worry about maybe your rental expense increasing a year from now when you renew your lease. Many clients that buy today are purchasing in more elevated interest rate levels. So, that does change the complexion of a monthly payment. However, they will have opportunity to refinance down the road because rates do cycle just like the housing market cycles, and eventually they will cycle lower. And I'll comment a little bit more on interest rates a little bit later in tonight's class. Now, this is also an asset that has the opportunity to grow over time. So, as your home goes up in value and as you continue to make your mortgage payments, that balance drops further and further. Well, the difference between a home value and a balance is home equity. And for most of us that are homeowners today, that's probably our number one asset that we have, aside from maybe a 401k or some pension that we're paying into. So, this is a big financial commitment, but it also has huge financial upside. And speaking of upside, there's also tax benefits that come along with owning a home. Potential tax deductibility around interest, as well as when I decide to make energy efficient improvements to my home, those can also lead to some tax improvements for me too. So I always encourage clients, don't necessarily factor your budget at home ownership the same as it would look like from a rental perspective, because when you add in the elements of tax savings, equity appreciation, and all those important things, that can make home ownership a lot more reasonable for you, but might also help equip you with a little bit more buying power than what you thought you had. To illustrate that point, I want to just take us through a calculator, which is one of our many tools that we offer to our first-time buyers. This calculator can help kind of frame up exactly what I just shared with you, but from a numeric perspective. So let's say we're going to buy a house for $350,000, right? Now you're going to learn tonight that the minimum down payment to purchase a home is 3%. So essentially I'm financing 97% of my purchase price, or 339,500. We plug in an interest rate so we can figure out a monthly payment, the time that I'm going to have that loan. So generally it's a 30-year fixed mortgage term, when I'm going to buy. And we're going to learn about this concept tonight, which is around mortgage insurance. Like when I put less than 20% down, I'm going to have mortgage insurance on my home. So it's a little bit higher when I put the minimum amount of 3%, but that has a factor of essentially 3.37 that we add into the equation. We have homeowners insurance. We have taxes, HOA fees if I'm deciding to purchase a condominium, maybe a townhouse. And then this is one of the assumption areas that we really want to look at carefully, because this is where it creates that area of opportunity for you in homeownership. What tax bracket am I at? What are my maintenance costs going to be on my home? Eventually, I'll probably sell my home. So how much expenses am I going to have when I decide to sell my home? I was just talking about one of our clients, from 10 years ago. They purchased their home 10 years ago, purchased it X amount of dollars, and they have all this appreciation that they've received. Now my client is in a position where she wants a different type of property. Now she has equity that she can transfer into the next opportunity. So really, as first-time buyers, we can use this first purchase as really a building block for us for another home down the road. And speaking of that, that's where that appreciation component comes in. So we're going to assume that this person is going to have about 3% appreciation. And then on the rental side of the equation, we assume someone that's paying $1,750 in rent. They have some cost around renter's insurance, and then that their rent will go up about 2% on an annualized basis. So that's kind of the two columns we have, right? We have a buy side, we have a rent side. So when we run this through our calculator, it gives us a break-even point. In this scenario that I've shared with you, 3 years is the break-even point. So that means that with the investments I make in down payment and closing costs to buy my home, when I factor that against what I'm going to be paying in rent over that same 3 years, and of course appreciation and tax benefits, my break-even point is 3 years of home owning versus renting. Generally, we would want our clients to break even in 3 to 4 years or less. So we definitely hit the mark there. But as we go further into ownership, that's where I think it gets a little bit more interesting. We start making more money. This asset is really working for us. So, going from 3 years to out to maybe 10 years, now I have about an $84,000 buy opportunity versus continuing to rent, and probably throwing away some money, right? You're probably paying your landlord's mortgage. But you just are really missing out more on the opportunity to have an asset that ultimately is kind of growing for you. All right. So that is our rent versus buying calculator. You can find that link in the deck page that we're going to send out to you tomorrow. I'd encourage you to go through that exercise yourself. But if you get a chance to get connected with us for a consultation, I'll walk you through that too as part of our services during the consultation. All right, well, now we're going to pivot a little bit. I'm going to talk about the housing market. We're going to specifically look at the Texas housing market, and we can make some commentary on the overall national housing market. Collectively across the country, we go through cycles or seasonality in our housing market where we get our busier months in the spring and summer. Generally, after Super Bowl weekend is when we start buyer activity start to really pick up. So then that leads us into like the latter part of March, April, May, June. That's all your spring buying. And then we move into, June, July, August. We see the summer months of buying. Why that is busier than most parts of the times of the year is because, hey, it's nicer weather in most parts of the country, especially you live in more of a cold weather state. Maybe you're relocating for a job. Maybe you're trying to get in a certain community because of a school district for your children, whatever the case may be. But that's where we see the seasonalities in the market. Now, right now in the market as we stand right now, it is the spring buying season. So it is pretty active in the market, even though in kind of this economic climate that we're in and kind of the geopolitical environment and globally what's happening, it still really hasn't deterred buyer activity out there. It has changed the price point in interest rates, which we'll talk about in just a second. In the Texas market, there is supply in that market. That's one of 4 states in the country right now that have some of the larger amounts of supply. So there's 91 days backlog of inventory on the market across Texas, which is up there with Colorado, Georgia, and Florida that have the highest number of supply or units on the market. So It is definitely a buyer's market in Texas. And so that's a good thing for us that are going to be buying in whatever market of Texas, because you do have a bit of a leverage point, if you will. You can see, even though prices are starting to inch up a little bit, we did have a pretty big drop here to start 26, and now they're kind of inching up just a tinge. But this number is kind of what I'm paying close attention to. We essentially have 3 days, or sorry, 3 months average days on the market, which is significant. And you can see kind of some of the metrics here of, median prices has fallen just a little bit year over year, and the number of properties available on the market. So, I think for those of us looking in the Texas market, there's certainly some opportunities, but I think there's opportunities across all markets in the country. Our national forecast call for 2026 to be a bit of a reset in the home buying space. So maybe a little bit more affordable, especially if rates can dip down a little bit. We will have maybe some modest price growth, but then we're not going to see any like massive jumps in equity increase for existing homeowners or for the price points that we see across the market. And inventory should improve. So the supply of homes that are available should improve all across the local markets that we serve. Of course, areas that I mentioned to you already have plenty of supply right now. And it's just really about the buyers that are willing to make a plunge kind of into the market. So I do think, even in the midst of kind of what we're dealing with right now on the economic side, I think there is some opportunities for first-time buyers to have a good entry point into the market. Here's what our forecasts look like from a metrics perspective. So in the Texas housing market, we're expecting price growth to go up by plus 4%, home sales to jump from 2 to 3%, mortgage rates, and we'll talk about that in just a bit. Our projections are probably going to get adjusted a little bit just because of what's happening in the conflict in the Middle East right now and what we're seeing in the economy right now. But we'll talk about that in just a second. New housing starts, so new builders beginning construction, that ticking up a little bit. Rents slightly going up a bit. And then inventory, as I mentioned earlier, more on the buyer-friendly side. So it's going to be more of a buyer's market in Texas. We can't say that in every market across the country that we serve, but certainly in Texas, we're seeing some opportunities for our buyers. Now, I think for every market across the country, what's going to be dependent on when the buyers make entry into the market is kind of really what's happening with interest rates. On February 27th, interest rates were just about to go sub 6%. And then over the weekend, the conflict arose in the Middle East. And then rates jumped up to about 6.25% just overnight in the next trading day. Rates last Friday hit as high as 6.75%. They've since reeled down a little bit. So this graph doesn't really show us what we're actively working with. But right now, average interest rate is about 6.3 to 6.5. What's driving that? Well, there is some concerns about when the war will end in the Middle East. And so that's putting a little bit of a kind of a dark cloud across the markets. Although there has been some signs that maybe there might be an agreement at some point. So you've noticed, if you guys watch the stock markets rallied the last 3 days. So has interest rates, thank goodness. We are watching really carefully and I've never thought I'd have to look at this, but we are looking at the price of oil per barrel, which is still over $100 a barrel, because that is driving some of this concern in the marketplace. But typically, the two metrics that we're really looking at is inflation, which we saw kind of about a level reading of inflation in one of the reports that came out today. And then Friday, we're going to be looking at the other metric is around the payroll and labor numbers out there, because the Federal Reserve is watching what's happening in the economy and then making a decision if they're going to cut rates or not. And so we're really in this kind of like gray area right now. We don't know if the Feds are going to cut rates this year or not. It was led to believe last week that that's probably not going to happen, but I think there are some signs that could still be the case. So takeaway here in interest rates is it going to be a very kind of a seesaw effect in the economy, especially for the balance of 26. Our projections had rates going to the high fives this year. I don't think that's going to happen. I love to be surprised, but I think our projections are going to be tweaked now given what's happened. But ultimately, I still think there's a really good entry point for buyers in the market. Now, what does make up an interest rate? Well, interest rates are not the same. It's not a one size fits all for interest rates. There's elements that go into an interest rate qualifying, things like your credit score and your eligibility for a specific program. That program that you're going to use, whether that's FHA or conventional, the down payment that you're going to have on hand. If you're deciding to buy points on your mortgage, which basically means I'm putting more expenses out of pocket to bring down my interest rate, that can influence my interest rate, and then the term of my loan. So if I can shorten my term of my loan from, say, a traditional 30-year fixed mortgage to maybe a 15-year fixed mortgage, perhaps that saves me anywhere between a quarter to a 0.5% in interest rate. As we get a chance to meet with you for your free consultation, whenever that time arises for you, we're going to figure out the right product set for you and see what makes the most sense, given your goals around home ownership. So it's kind of a little bit of a fluid process, but ultimately you do have options to consider as a first-time buyer. Now, one of the bigger things that goes into the equation around product selection, interest rate, and what we're going to talk about in a few minutes, mortgage insurance, is credit. Every program has a minimum credit score. And then the way pricing works for interest rates and mortgage insurance, they're all at tiered pricing levels. So the higher I can raise my credit score, the better my financing options become and less expensive. So I create essentially better affordability for myself. So when we do classes like this, I want to give you guys some tips and some resources so you can identify areas of opportunity on your own credit score. Now, we all know there's 3 credit agencies that report out: Equifax, TransUnion, Experian. They all give us different scores because they have different risk calculations. In lending, we always take the middle score of all 3 of those reported scores. So if my highest score is 780, my middle score is 760, my lowest score is 720, well, in lending, we're going to use that 760 score for qualifying. If I'm going to have my partner join, but my partner's middle score is, let's say, 720, well, we're going to use this 720 score because that's the lowest middle score between the 2 of us. All right. So as we get a chance to meet with you and look at your credit, we're going to identify those areas of opportunity to help improve your credit score. And the one of the things I always encourage clients is that when you apply for financing with our team, just because we get a score that comes back at, say, 680 doesn't mean that's the bottom line number. We're going to talk through and try to customize home buying plans for you and say, hey, Jason, if you can get your score to 720, well, this is what the rate's going to look like. So it's a very fluid process. It's more customized for our clients. When we look at a credit report, the negative items or past challenges we've had on our credit report, it's going to impact you in the most recent 12 to 24 months from the date of the event. So if I had a late payment on a student loan back in October of 25, it's probably still impacting my credit score. But as I move further away from that late payment, I'm going to start to see some kind of organic improvement in my credit score. So it's in that 12 to 24 month window. Now, that late payment will stay on my credit report longer. As you can see on this matrix here on screen, it's going to be on my credit report for 7 years. But how it hurts my credit score is in that most recent 12 to 24 months from the date of the event. As you have larger items or more significant items on your credit, like let's say a charged off account or a collection account, probably can have a bigger impact on my score in terms of how it drops my score, but the lasting effect will still be in that 12 to 24 month cycle. So here's where it gets into kind of areas of opportunity for you. This is the FICO score calculation for the mortgage score. And by the way, there's 3 different scoring models that you should be aware of. There's a credit card model, there's auto, and then there's a mortgage model. So for those of you that subscribe to Credit Karma or some of the other tools that are out there, they are going to use a credit card score. So it might not be reflective of what your actual mortgage score is. So we'll probably see some variance between those 2 score models. Here's what this score model looks like for mortgage. One is we have length of credit, which is essentially how long have I had credit. The more mature my credit file is, the better my score is probably going to be. 20% is going to be how much new credit am I trying to get access to? So the more accounts I'm opening up in a recent span of time, especially in the most recent, like 6 to 12 months, that's going to be the impact to your score. And then if I have new inquiries that are showing up on my credit report, we call those hard inquiries. Those are going to drain my credit score. Now, one of our differences in our process, as opposed to different lenders that are out there in the marketplace, we only start with a soft credit check. And the reason why we do the soft credit check is we want to be able to provide you some options around home ownership without impacting your credit score. So our process only starts with that soft check. Next component, which is this is probably the biggest area of opportunity for most buyers that I work with, and that's around revolving credit. It's paying down credit cards and lines of credit, trying to get those at the lowest possible levels to help lift that credit score and lower the utilization. So if you look at one of your credit card statements, the credit reporting agency is measuring your balance to your limits. So for example, if I have a $5,000 balance and my limit's $10,000, right now I'm at 50% utilization. not bad, but ideally we want to be at 10% or less utilization. So that balance down to $1,000 or less. So when that billing cycle date closes out on your credit report or credit card, and this is kind of one of our tips for you, if you look at your statement for your credit card, when that billing cycle date closes, that means the preceding 30 days is now closed out on your credit card. My tip for our class tonight is try to pay off that credit card or pay it down before you close out that credit activity date or the billing cycle date. Because if you do that, you can get a much lower balance reported out to the agencies, therefore lifting your credit score and hopefully, obviously, saving you in your financing costs. All right, so that's on the revolving utilization side. Last side of this kind of wheel, if you will, with the mortgage model is payment history. That's obviously how I've paid my bills. If I've had any late payments, especially in those 12 to 24 month window, that's where it's going to really impact my credit score. If you've had a late payment, they're rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. One of the creditors that do show up on credit reports is student loans. And, I'm hearing from more clients that we're starting to see some more activity with student loans. I think some federal student loans are coming back online for payments in June and July. So something we want to be aware of, especially as you guys, take that step towards homeownership and kind of how we view it. If you've already been making payments on a savings plan, which would be like an income-based repayment program, what we have over here, we can take that payment right away for qualifying. So if you owe $75,000 in debt and you're paying $250, well, we can use that right away for qualifying. Where it gets a little tricky is if a lot of our clients are not making payments because they're in forbearance or maybe they're back in school and now they're getting notices from their servicer that, yeah, you're going to start payments in July or whenever. If you're applying for a mortgage today, we have to use a minimum payment to calculate in what we call debt to income ratio. So if you owe that same $75,000 in debt, but you're not actively making payments, we would count 1% of the balance as the monthly payment. So that would be $750 for a conventional loan. If you're doing an FHA loan, it'd be $375. And so we'll go through those calculations with you to see how student loans impact or hurt your qualifying, but it's not something that is going to prevent you from homeownership. But I think we just got to get a better understanding of those student loans. So as a takeaway from that section, if you're in forbearance or deferment, there's still a payment that gets calculated into your qualifying. And of course, if you're in a savings plan, we can use that payment right away. The reason why we're going to ask for those items and identify that for you as we build your plan for homeownership is because programs like you have on screen here have guidelines that address student loans in particular, as well as other components to the home buying scenario. So let's give you kind of a high level look at products and give you some terminology, which I'm sure you've heard in maybe some of your searches already that you guys are doing. But the first product set is going to be the conventional product, which is Fannie Mae and Freddie Mac. It does have a 3% minimum down payment. And really that 3% down minimum stretches all the way up to the maximum conforming loan limit, which is $832,750. If you're joining us from, say, Los Angeles, California, well, that's a high cost of living market. We can go up to $1,209,000, I believe it is. But the minimum down payment jumps from 3% to 5%. All right, so that's both for Fannie Mae and Freddie Mac. FHA is the next product. That's the Federal Housing Administration. That's a government insured loan, not just for first-time buyers. In fact, I was meeting with a couple earlier today, and they thought they had to go with FHA because they're first-time buyers. Not the case. You can do a conventional loan or an FHA loan, or frankly, a VA loan if you're eligible. But the FHA loan has a 3.5% minimum down payment, 580 minimum credit score, but the maximum loan amount changes by the county that you want to purchase in. And then FHA is a government insured loan as well as USDA. Now, USDA is a little bit different because you have to buy in a rural area and you have to meet some housing income thresholds or requirements. You can't exceed them, I should say. Now, both of those are government insured loans, and you do have to be permanent residents to participate in those programs. There was some changes made, unfortunately, about 5 months ago now that changed like who gets access to those programs. Now, you can still be a non-permanent resident and still participate in a conventional loan. And then the jumbo loan is going to be really for clients that want to purchase some more kind of with higher price levels that stretch beyond some of the conventional loan limits. So we need, million plus financing options. And then the VA home loan is going to be for our veterans that have eligibility around the VA product, zero down payment option, just a lot more flexibility in the qualifying guidelines for the veteran with really no maximum loan amount. But you do have to have VA eligibility. One of the products that we have that's kind of like a boutique product that we also offer is a physician's home loan. So for some of our veterinarians, dentists, active practicing physicians, there are physicians programs that will help you if you're eligible with kind of more relaxed guidelines in student loans, a little bit more flexibility in down payment. So if you're interested in looking at one of the physicians programs too, we can certainly have that conversation. All right, we're going to talk a little bit about mortgage insurance. There's not a day that goes by that I don't talk about mortgage insurance with clients or in our classes, but it's important to really help you understand a little bit more about mortgage insurance. And we're going to compare that around both the conventional and the FHA product. Conventional loans have PMI, which is private mortgage insurance, and then FHA, which is a government insured loan, has mortgage insurance premium or MIP. There's different calculations for those different products. The conventional loan, the way PMI is calculated is based upon down payment, credit score, and how much you finance. Now, one of the benefits with a conventional PMI product is there's a cancellation option. So once I reach 2 years in my home and I have 20 to 22% equity, I can apply to have the mortgage insurance canceled. And as you look at our payment scenario down below, if I have a 740 credit score and I have a 3% down payment, a PMI is relatively reasonable. It's at $92 a month. On the FHA side, there's two forms of mortgage insurance. There's monthly mortgage insurance, and there's also upfront mortgage insurance. But one of the key differences, not only is it a little bit more expensive with FHA, the mortgage insurance on FHA cannot be canceled. Only can be canceled essentially if I refinance into a different product. And then below here, guys can see the expenses. So we have the upfront mortgage insurance, and then we have the monthly mortgage insurance. So with FHA, I consider that, more of an entry point for homeownership. It's not going to be our long-term loan that our clients would select because ultimately FHA is going to give us a little bit more flexibility in qualifying as opposed to a conventional loan. I think I shared with class, we had that scenario where I had a student loan, let's say in October as a buyer, and that might prevent me from getting access to a conventional loan because maybe it's dropped my credit score and it shows as a late in the last 12 months. FHA would probably be a little bit more okay with that. So as we kind of customize a home buying plan for you, we're going to figure out what the right product mix is for you in our conversation. All right. Now we're going to talk a little bit about income now. And so before I go that, I just want to make sure that and share because some of us might have joined late. We have, feel free to answer or ask any questions in the chat or the Q&A. I'm kind of watching both windows right now. But if you have any questions on some of the content we've already provided, feel free to drop that in there. I see a hand raised in class, so feel free, Gavin, if you want to drop your question in, I can more than happy to get that answer for you. All right, I'll wait for that to come in. Okay, we'll see if he drops his question. I'll keep us going so we can keep ourselves on track for time. But we're going to talk a little bit about qualifying income, but more so like kind of employment, because I get a lot of questions around that. Sorry, Gabby, yes, we're recording tonight's class. So absolutely. Yeah, and thanks for joining us. So with employment, there's different scenarios that we want to consider when it comes to qualifying in a mortgage. And in lending, we always verify the last 2 years of work and or educational history. So we don't necessarily have to have a scenario where we have 2 years on the job. As long as we can put together 2 years work history, which can be inclusive of education, that can help us with qualifying for a mortgage. So for example, I graduated, let's say from A&M in the fall, and I just started my job January 1. I can piece together my educational background plus it aligns with the job that I'm working for and started January 1. That would satisfy my 2-year requirement. Okay, so many people don't know that because we get so many scenarios like that, but also situations where people are looking to transfer to a new job. Well, you can qualify with a new job offering. In fact, one of your fellow alum that we're working on a home purchase for right now is getting ready to start a new job, but looking to buy in advance of starting the job. And you can actually do that in financing as long as you have a fully accepted job offer with no conditions and a date of employment. That is an option. You can still buy today with an offer letter. Now, where it gets a little bit trickier is that if you're trying to use maybe dual sources of income, so let's say you're working for two employers, but you want to use both sources of income for your qualifying. In that case, we have to show that you've been on both jobs simultaneously for 2 years in order to count that income. That 2-year rule would also apply to self-employed individuals. So if I have let's say a trucking business, right? And I want to count my income towards qualifying, I have to show that I've had my business and file tax returns for 2 years. If I have variable sources of income, so let's say I have a base salary, but then I also get bonuses or commissions, that would be, if I want those variable sources to be considered, then I have to show I've been with my employer for at least 2 years in order to count both sources of income. So, other scenarios would be like, we have clients that work for Google, right? And Google may give you stock options that you have, or, an incentive plan. So those would be considered variable sources of income. To my point earlier, if we have 2 years with Google, then I can use that as a source of income for qualifying. Okay. Last thing I just want to point out to you is that if, let's say, you have other sources of income like a partner, but that partner doesn't want to be part of the application, we can't unfortunately blend in the income from your partner unless they want to be a part of the application in the transaction. All right, so let's get a little bit of a look into income. We also on that slide provided you with some of the acceptable sources. Sorry, not acceptable sources, but acceptable documentation for the process. So as we think about maybe starting this journey together, some of the documents you might need to start gathering as we prepare you for home ownership. All right, and kind of like dovetailing off of income, I want to share with you a calculation that we use in qualifying. It's called debt to income ratio calculation. It essentially looks at your expenses that you have today, student loans, credit cards, auto payments, but then we also add on the new housing expense, like what's your principal and interest on your mortgage, your taxes for the house, homeowners insurance, mortgage insurance, all that stuff, right? And we compare those expenses versus your income. And in fact, we have a calculation here, which is noted as someone that has a $2,500 housing payment with $500 in debt, and they're making $8,500 a month in pre-tax income. So this metrics as a lender tells us, what percentage of income is going out to those expenses. And generally, we don't want it to be any higher than 45 to 50%. This particular client is at 35 to 35.3%, which would kind of be in the sweet spot, if you will, as I would say it. As I coach clients in home ownership, usually 33% debt to income ratio to 36% is kind of the comfort zone or excellent level, if you will. Everybody has a certain tolerance level of how high they want to go in debt to income ratio. I would say the big question I get is around what my payment should be, and that's really around affordability. And that's a really kind of a bigger conversation individually because everybody kind of looks at their monthly expenses differently. Some people want to have a certain surplus on a monthly basis, and so maybe that $3,000 a month payment feels a little tight. It feels better at $2,250 because that $750 gives us that little cushion, whatever the case may be. But as we work for you and help plan home ownership, we want to make sure we create an affordable plan for you, but also make sure that's sustainable. So you feel like you can enjoy home ownership without any of the stresses of making ends meet every month. All right. So the last component to building a home buying plan is really around savings for home ownership. And quite honestly, for our class, this is probably one of the bigger challenges for most buyers that we work with. We'll spend some time tonight looking at some of the local Texas programs that we partner with, but savings for home ownership can be a challenge. Now, we can verify assets that are used in a home purchase and checking and savings accounts. We can't use cash per se. We have to paper trail every asset used in a home purchase. Retirement accounts can be used, investment accounts. Even family members can help gift funds into the transaction. Basically, every asset used in a home purchase has to be seasoned for at least 60 days. Gift funds do not, as long as we can see the money coming from the donor. Now, thinking about this being a challenge, I thought I would share with you, just a quick resource or tip, I guess, in approach to savings for home ownership. And it's a very simple mathematical equation, but essentially, if you were to be in a position today where you're spending, let's say, $1,500 a month in rent, but you meet with us and after designing your home buying plan, the budget for home ownership probably needs to be about $3,000 a month. To prepare yourself for home ownership and to start saving towards that goal, what I would encourage our client to do is let's start saving today like I'm making that $3,000 mortgage payment. So at the first of the month, I pay my landlord the $1,500. I create that discipline where I have another $1,500 that goes right to my savings account. I continue to do that for the next several months. I start seeing that savings account balance rise. The end of 6 months, I have $9,000 built up. End of the year, I have $18,000. Now I've created a nice little nest egg for myself for home ownership. And oh, by the way, we've also created like that discipline. So when I transition to home ownership and now my mortgage payment's $3,000 or $2,500, doesn't feel as big of a lift for me when it comes to my monthly budget. So easy way to approach savings. We've had several clients that have taken on that exact approach, and we found it to be really successful. I'd encourage you guys to kind of take a look at that yourself. I did get a question about what does seasoned mean? So let me just kind of backtrack a little bit. So seasoned basically means is that the asset has lived in your account for at least 60 days. So when it's deemed seasoned, that means it's been in there 60 days. So now that asset can be used. So generally, we would want to see at least 2 months of statements showing that that asset or that balance has remained. All right. Well, as I said, savings can be a little bit of a challenge. There's tools and resources all across the country. We didn't poll our audience to see where you're at or where you want to buy, but if we make the assumption that a lot of us are in the Texas market, we partner with the Texas State Affordable Program, and I've got a chance to help several clients with these programs. Um, Great tool to help like close the gap for you when it comes to what you need for down payment and closing costs. You can get up to 5% in down payment assistance. And then the way these are built with the Texas State Affordable Program is they're basically a forgivable loan that after 3 years they're forgiven. There's also some special incentives for first responders and military and teachers. And one of the unique things with this program is they offer a mortgage credit certificate, which is not available across the country collectively. So kind of a unique product, but essentially what a mortgage credit certificate does, it provides you an interest tax credit of up to 10% of the interest you pay on an annual basis back to you in the form of a tax credit, which is going to be a really powerful tool for you. And we can reissue that mortgage credit certificate. So it's good for the length of the time of the 30 years that you have that home. So great tool for you to have in your tool belt of first-time buyer resources. Now, there's very similar programs, may not necessarily be the MCC, but there's very similar first-time buyer programs all across the market. So whether you're in Florida, there's a first-time buyer program there, or you're in Colorado or California, whatever the case may be, we have first-time buyer resources that we can plug you into. So if you're interested in maybe not in the Texas market, please let me know. I'd love to be able to kind of get you connected with some of those first-time buyer resources that might fit for you. Now, nationally, there's also some first-time buyer resources that are designed to help low to very low income households. Generally, when you make less than 80% of median income, you can tap into some of the low income resources nationally. I did want to add too, with some of the programs like Texas State Affordable, there are income limits that are set by the county that you're going to buy in within the state. So we can certainly pass those along to you guys, and then obviously talk one-on-one if you're looking at a specific market, and we can let you know if you qualify for that program or not. Now, nationally, we have another program within APM called Pathway. Does not have the income limit restrictions, but it only works for an FHA loan. But you can essentially get anywhere between 3.5% to 5% of your sales price in assistance resources. And that essentially goes towards down payment and closing costs. So what we're trying to do with these resources to hopefully satisfy the minimum down payment, but also cover the expenses like closing costs when you purchase a home. Closing costs, I generally recommend clients to budget somewhere around 2 to 3% of their sales price for those expenses. All right, well, we're getting close to the finish line, but this is probably one of the more important segments, I guess, if you will, within our class. And that's to talk about the buying process. Where do we go from here after tonight's class? Well, we want to provide you with a visual tool to understand the next steps in homeownership and how you get there. Obviously, it starts with a class and our relationship here and just helping you get some key concepts down. The next step is to meet with us for a consultation, and that's a virtual session that we also provide to you, which is a free service we give to our communities to design a home buying plan, which is like 30 minutes one-on-one to make sure you have some goals and some objectives around home ownership and just see what tools and resources can best match up for you. The output of that meeting takes us to step one, which is the pre-approval consultation, or the output of the pre-approval consultation, which is to get a pre-approval. And you don't have to act on that pre-approval and go out and run out and buy a house, this weekend, but it just gives you the framework for what your eligibility looks like. So whether you decide to act on that this year in 26, or it's going to be something you're going to shelf for a couple years, at least you know what your qualifying parameters look like. Now, if you're ready to go out and start shopping, then you move to step two, and that is the house hunting phase of the process. We would encourage you to get connected with the local realtor. We have a fantastic network of realtors that we can introduce you to, but that would be the next step in the process. You look at online listings, work with a realtor on maybe a particular property that you're looking at, or maybe you jump in the car and spend a whole Saturday looking at different homes. But step two would be the house hunting phase. Then, once you've identified a home that you want to move forward on, the realtor would help design an offer for you and submit that to the seller for consideration. Let's say that offer gets accepted. Then guess what? Now you're in escrow. You've entered escrow. It's called different things in different parts of the country, but ultimately what it means is you have an agreement with you and the seller as a ratified contract. Now, the day we get word that you've got that offer accepted, I'm going to give you a call and say, congratulations, your offer is accepted. Let's talk a little bit about what to expect going forward. Let's set some action items and get you scheduled for your follow-up video session. I meet with all of our clients to make sure that all the financing is designed properly, and then we kind of go through some different milestones that they'll experience in the process. Now, as a new buyer, you're going to have some requirements as part of the contract, like making a deposit for the house to secure it. Usually it's about 1% to 2% of the purchase price. And then that money that you're depositing with a title company, an attorney, or an escrow team, that will all count towards your total out-of-pocket expense. Now, inside the contract, there's some provisions in there called contingencies, which give you some protections as a buyer, which would include getting your appraisal done to make sure that the house appraises for what you're buying it for, get your inspections done, make sure everything kind of checks out in the house, and then getting your loan approved. In most parts of the country, that contingency period can run from 7 days as the shortest, all the way up to like 21 to 30 days. But as your lending partner, we're going to help kind of support you on getting all the key tools in place to make sure you understand what the house is worth and make sure your loan's approved. So when you do decide to lift your contingency and sign off on that, that you feel good about where your financing is at. So as we move down through this process, and by the way, from step three, I should say, to step six, most markets, it's about a 30-day process. It can be a little bit longer. You may have a 45-day escrow on a place in Houston. That might just be what you negotiate with the seller, but it's on average about 30 days. Some markets, there's some California markets that is as short as 14 days, so it really just depends. We'll continue to move down our visual process here, and the step four is going to be processing and underwriting. That's more the administrative task. That's verifying employment, verifying assets, and just making sure everything is packaged up correctly, because an underwriter will now review everything in your financing. One quick note I wanted to make for you guys is that we talked a little bit about interest rates tonight. Especially in this market, interest rates are very volatile. So once we're under contract with a seller here at step three, then we start talking about interest rates and strategically watching the market. That's one of our value adds to our clients is I have a dashboard up watching the economy really closely, because it is a very time sensitive type thing. And we want to make sure we can capture the lowest interest rate opportunity for you. Step five is going to get us to the loan approval stage. Now at that point, we're almost nearing close to the finish line. Underwriter says, yes, we're good to go. We've gotten some disclosures out to you by that time. There are disclosures that go out to you, different milestones in the process, but at step five, we're going to issue you a final closing disclosure. That essentially gives you a 3-day cooling off period before we get to the very final milestone. That's called the closing of the home loan. If you're in Texas, Texas is what we call a table funding state. So the date you sign final loan documents and deliver your final funds is actually the same day you get your keys. If you're in a market like California, you would sign on one day and fund your loan on the next day. But ultimately at step six, you're signing final loan documents in person, delivering your final funds for closing. Then the transaction basically closes out, because now documents will get recorded with the county recorder's office. And once they get confirmations back that those have been all recorded online, then now you become the official owner. And that is a huge day of celebration. In fact, after this class, I got to call one of our clients on the West Coast to congratulate them because they just got confirmation of recording. It is a huge celebration, and it's a huge financial milestone for all of us. And it does generally start in a classroom setting like this, but once they get to the finish line, it is a huge, huge thing to celebrate. So that's kind of what the process looks like. But our relationships with our clients don't end there. Part of our aftercare program, we're always tracking what rates are doing in the market. So when a refinance opportunity presents itself through our rate watch system, we always send out tools like our HomeBot system, so our active clients can track their home equity position, and certainly checking with them on an annual basis just to see what's happening financially. as we wrap up tonight's class, I just want to let you know how you can get started and understand a little bit more about home ownership for you and a customized plan. You can do that by just completing our real simple get started information, completing an online application. You'll be required to upload some documents. And then you'll use our scheduling system, which you can see here, just to schedule a video session, or if you want to do phone, that's fine too. But that is a 30 minutes free service we provide just to design all the framework to home buying. And it looks a little bit like this. A lot of the same concepts that we reviewed in tonight's class, we'll now take those and then apply those to your own personal situation. Budgeting, credit, product selection, first-time buyer programs, workflow, all that stuff that's really important as you think more about home ownership. And technology is something we always embrace with our team, whether that's leveraging the efficiencies of AI or leveraging mobile. You can see you can start from mobile right here as we have the links to our mobile app here, but it doesn't replace the human element to this massive purchase that you're going to make. So whether that's getting connected with me by phone, text, email, whatever it is, we always want to make sure we're here as a support system for you guys. Last thing I want to point out to you is just our discount program that we provide to the community for the Association of Former Students. We discount our services here. So not only are you also getting the tools in our classes, but you're getting great products and service and expertise, but we're also going to discount our services to help you. Again, this class is being recorded. We're going to get all the information to you guys. We provide this value 4 times a year, but if you do have friends or family or coworkers that might benefit from this as well, encourage them to come to one of our classes. We'll teach over 10,000 future home buyers in homeownership this year. Obviously, you're one of them too, but we love to be able to have you share that information with some friends and family and check out some of our upcoming classes. And here's all my information. So if you want to reach out to me and anything I can provide to you, love to be able to have a conversation and see how we can best support you. And we also love what our community says about us in our socials, whether that's some of the testimonials you'll see on our Google reviews or posts about new home ownership for some of our buyers on our Instagram, or just some of what some of the Reddit communities say about us and what their experience has been with us. We really are just really grateful for what our community says about how we serve our clients in home ownership, because we understand this is going to be a major financial milestone for you, and we want to make sure that we're just a partner for you along in that journey. Okay, so that's our class for tonight. Now we're going to carve out some time for some questions. If you guys do have any questions, love to be able to answer those for you guys on air. And then of course, we'll get you all the slides from tonight, and we're recording this, so this will be up on our YouTube channel, and then and our team will get that posted there for you guys as well. All right. Any questions from our class? I know a lot of you still staying in. And I know some of you that maybe are not in the central time zone, maybe got in a little bit late, but that's okay. We got this all recorded for you, and you can check it out when you have a free moment too. All right. Any questions? Going once, going twice. All right. Okay. I did have a question pop up. One-time closed construction loans, how early should I start the process? For the definition for the group, a one-time close is basically allowing you to get construction financing, and then you kind of bundle everything to a one-time close and have one final financing vehicle at the end of the transaction. I think if you're getting ready to start construction, I think we should start having the conversation now. We have a construction/renovation team that's what their specialty is construction products. So love to be able to get you introduced to them, and we can certainly, just have that connection built for you. So if you want to connect with us after class, love to be able to do that for you. But I definitely don't think it's too early to start the process. I think and that kind of goes for every product I think that we offer in every scenario. I think it's good to get this process started as soon as possible so you have some goals and objectives around home ownership. I can't tell you how many clients I meet with that are maybe a year or 2 years away from buying a house, and it's good to still have the conversations now. I mentioned it earlier, it's like I don't expect clients to meet with me and then jump in the car and find a house this weekend. That's just not how it works. We want to make sure that you understand kind of what it looks like, and then when you feel like you're financially ready, then you go out and make the move. All right. Thanks for that question. Yeah, definitely would love to get you connected with our construction renovation team on that for sure. Okay. All right. Well, I think we think we did it. I appreciate everybody being involved in tonight's class. Hopefully, you got a few takeaways for yourself, and then hopefully get a chance to get connected with you and just help design your options and kind of help you down that path towards home ownership. So, have a wonderful evening, everyone. Look forward to seeing you all soon and enjoy the rest of your week. Good night.